Okay, let's start. So, see, what we basically need to understand here is it's divided into three parts. The first part, we need to understand that what is the meaning of inventory and which all costs are to be included and which all costs are to be excluded from inventory. This is the first part. Second part would be various methods of inventory valuations. So there's going to be a method called LIFO, there's going to be a method called Fifo, then there would be a weighted average, and then there would be a method called specific identification. This is the second part. And third part, we'll try to understand that what is the meaning of a perpetual inventory valuation system and what is the meaning of a periodical inventory valuation system. So now let's start with the first part. Let me ask you a question. Let's say that in 2005 you purchased an inventory or you purchased raw material worth 10,000. You did not make any sales in this year. What is the amount of expense that you have in 2005? What is the amount of expense that you are going to report in 2005? 10,000. The amount of expense in 2005 is going to be 0. The reason being that you did not consume this raw material. Even if you consume, if you did not sell it, then it is your inventory. It is not the expense that you've incurred. Now in 2006, you started processing this raw material. So I forgot to write this. Expense 0, inventory 10,000. In 2006, now you spend some amount of labor on this, and the amount of labor charges to process this inventory here was 5,000. So now, what would be your expense in 2006? Expense in 2006 is 0. The reason being that when you spend this 5,000, it helps you increase the value of the inventory. And if you have not sold this inventory, then value of your inventory has become 15,000, your expense is 0. 2007. Now finally you decided to package your goods, right? So there is a packaging cost of 7,000. Now what would be your expense in 2007? 0. Because now your inventory would become worth 22,000. So which basically means that till the time I am not selling this inventory, I am not going to incur an expenditure. But in 2008, if you sold all your inventory, everything, then your expense is going to be 22,000, which would be nothing but your COGS in that particular year. And then your value of inventory is going to be 0. And if your selling price was more than 22,000, it would be a profit. If it was less than 22,000, it's going to be a loss. That's it. Are we clear? So now next question, that what should be included in the cost of inventory? Yes, number one, we are going to include, of course, the raw material. We are going to include labor, all those processing charges, even electricity at times. So we call these expenses as direct conversion expenses. This also includes the freight, transportation. Whatever that cost that you incurred, so that value of that inventory increased, that cost would be directly included into the cost of inventory. Are we clear? Next question, what should not be included into the cost of inventory? Number one, very importantly, period cost. Period cost should not be included as a cost of the inventory. What does it mean? Let's say that you started your manufacturing operations in the month of January 2012. Now you purchase raw material of 10,000. If you have not sold it, this is your inventory. But in January 2010, you paid a rent of warehouse which was rupees 5,000. Now you can argue and you can say that Even if I did not have this premises, if I did not have this warehouse, I could have never processed my inventory. That means even 5,000, this expenditure was very important to increase the value of the inventory. Yes, but since this cost you are going to incur irrespective of what quantity you manufacture. This cost is directly related to period, it is not related to level of activity, and therefore it is not included in the cost of inventory. Clear? In the same fashion, second, there is something called abnormal loss that is never included as a part of the inventory. Now the question is that what is abnormal loss? Now to understand abnormal loss, we need to first understand normal loss. Now let's think of it this way. Let's say that there is a factory which manufactures, yes, think of any manufacturing product. Pens. Okay. Something which is relatively easy to manufacture. Huh? Cotton. Okay, let's think of it that it manufactures something where input and output is in the same unit. Okay, let's say chocolates. I'm thinking of a lot of chocolates these days. Now, to manufacture chocolates, you need to input. Let's say that our raw material that was input, which is collective of all the ingredients which are required for manufacturing chocolates. So let's say that our input was 100 kgs, and then we put it into our manufacturing process, and then it gave us an output of only 90 kgs. Why? Because there is going to be some sort of a loss during the manufacturing process. So now if the cost of this 100 kgs of raw material was 9,000, then I'm going to say, assuming a processing cost of 0, which would not be, but assuming a processing cost of 0, cost of final output would be 9,000. Very obvious. Now, this happens all the time. That means it is a set manufacturing practice that every time I input 100, I get output of 90. That 10 loss would be considered as normal loss. I didn't even account for it anywhere. I simply said inventory is 9,000. So in accounting, we ignore normal loss. We don't account for it. But now, let's say that you started your manufacturing with 100 kgs. And now, due to certain loss of electricity during the manufacturing process, you got a final output which was only 80 kgs. So now what you would say is that my normal loss is 10, but this time around I have also incurred abnormal loss of 10. So now the question is that should I say that value of this inventory of 80 kgs is 9,000? No. I would not say that value of this inventory is 9,000. I would remove the abnormal loss from here. I would say value of this inventory is 8,000. That 1,000 I would say is my abnormal loss, and that would be shown as an expense on your income statement. So abnormal loss is not included as a cost of inventory. Abnormal loss is shown as a expenditure. Are we clear? Should we move on? Yes? Okay. Now we are into the second part where we want to understand the various inventory valuation methods. Now first one of them is called as LIFO, which stands for Lastin First-Out. So what does it mean and why is it required? You think of a scenario, let's say that you start a business and you decide to start buying, but you say that let me not buy all my, let's say you want to be in some retail business, retail clothing. So you would say I don't want to buy everything at the one go, I want to buy it in installments. So you made certain purchases on first, so this is date. Then you made few purchases on second, then third, then fourth. Now the quantity that was purchased on first was 10. On second you purchased 50. On third you purchased 40. And fourth you purchased 100. And it's very obvious that price at which you would purchase, not necessarily that it's going to be same all the time. It would either increase or decrease. So now in this case, we'll assume an increasing price scenario. So you would say that price per unit here was 10 rupees, it became 20, it became 30, and it became 50 per unit. Though a very unlikely scenario within one day, but let's assume an extremely high price fluctuation. Now, let's say that you've sold 100 units, or let me say you've sold 110 units at some price. Let's say you sold it at 100 rupees per unit. Now the question is, I want to calculate my profit, and to calculate my profit I need to calculate my cost. But the problem is that all these, how many goods? 90, 100, 200, all these 200s are identical. So when I sold 110, I do not know exactly which 110 was sold out of those 200. So now how do I decide that what is the cost? So then, in case if I am using a method called LIFO, I am going to assume that last in is first out. That means the goods which were which were acquired last are going to be sold first. So if I have sold 110, I am going to assume that entire 100 were sold, and then 10 goods were sold from here. So my cost of goods sold is going to be 100 into 50, 5,000 plus 10 into 30, 300. My cost of goods sold is going to be 5,300. Now what would be the value of my closing inventory? So I am left with about 30 inventory here. So 30 into 30, 900, 50 into 20, 1000, 10 into 10, 100. The value of inventory which is left with me is 2000. So that means the amount of inventory on your balance sheet and the amount of COGS on your profit and loss account is going to vary depending on whether using a LIFO method or we are using a FIFO method. Are we clear with this? Yes. Now the next method is FIFO. In fact, we can use the same one. Now if I wanted to use FIFO and if I would have sold 110 units, I would say that entire 10, just a minute, entire 10 from here are sold, entire 50 from here are sold, 60, then entire 40 sold, 100, and then 10 units from here have been sold. So now what is my COGS? 10 into 10, 100, 50 into 20, 1000 plus 40 into 30, 1200 plus 10 into 50, 500. So COGS is going to be 1100 plus 1200, 2300 plus 500, 2800. And what is the amount of closing inventory left with me? So now closing inventory, since I have sold all of these and I have sold 10 from here, I am left with 90 here. So 90 into 50, 4500. So closing inventory is 4500. This is your FIFO, first in, first out. Now, just for understanding purpose, let's take a total of COGS plus closing inventory here. So 2800 plus 4500, how much? 7300. Yes. And take a total of this closing inventory and this COGS, 7300, which is basically the total of the entire price at which you had acquired all the inventory, total cost of acquisition. Are we clear? So this is what FIFO and LIFO means. Now instead of that, if you wanted to use a method called weighted average, so let's create a scenario. We would say 10 units at 10 rupees per unit, this is per unit price, this is quantity. 20 units at 5 rupees per unit, and 50 units at rupees, let's say 20 rupees per unit. So then you take a total of all of this, you will say 100, 100 and 1000. Total amount spent is equal to 1200. Total quantity acquired is 100 plus 20, 30 plus 50, 80. So total quantity acquired is 80, which means on an average your cost is going to be 15 rupees per unit. So my COGS would be calculated as number of units into 15, my weighted average, my closing inventory would be calculated as number of units into 15. This is called as the weighted average method, which is the third method. Are we clear here? Now the final method, which would be called as specific identification. And this method cannot be used in all the industries. This method can be used only and only when each and every item of your inventory is unique in nature. Think of a jewelry shop. So you go and you decide to buy a particular type of a necklace. Now a jeweler would, assuming that each and every type of jewelry is unique in nature, a jeweler would be able to identify that, okay, I sold a necklace with, let's say, 120 diamonds. Right? So that means since each and every type of inventory that you have is unique in nature, therefore we can use a specific identification. We can specifically identify that which unit of your inventory has been sold. Have you followed this method? This can also be used in case of vintage cars. And there was a 1990 some XYZ type of car that was there which was sold. Yeah, we cannot use this in case of regular cars. Why? Because each and every car would be exactly alike. Is this clear? Okay.
So this is true only for finished goods.
Yes, it is true only for finished goods. But we cannot make that kind of a statement. It might be true even for raw material. For example, let's say that your raw material is some sort of a, think of raw material which is different in quality. Probably let's say your raw material is
different type of wood.
Different types of
Wood.
wood. Okay. Yeah, so if your inventory is made of different types of wood, then we can use specific identification if the unit of that wood is same. Otherwise, if the inventory is made of same type of wood, huge quantity, then we'll have to use the earlier three methods. Okay. Now I'm asking you a question. Imagine a scenario where prices are rising. Now tell me that COGS is going to be higher in LIFO or it is going to be higher in Fifo. If the prices are rising, COGS would be higher where? It would be higher at LIFO. Why? Because in LIFO, the ones which I acquired last goes into the COGS, and since these are the ones which have been acquired at a higher price, I can safely say that in case of rising prices, that means in case of inflationary scenario, the LIFO COGS is always higher than Fifo COGS.
But the quantities are different. What if the quantities are different?
It doesn't matter. That even if quantities are different, when we say COGS, it is number of units into the price. When I am comparing with Fifo and LIFO, assuming that I have sold same quantity, in fact, let's say I have sold 20 units, then those 20 units in LIFO would be used at a higher prices, and in Fifo those would be used at a lower prices. In case of rising prices, in which scenario your profits are going to be higher? Profits would be higher in Fifo because your COGS is lesser. In which scenario your inventory turnover ratio would be higher? In which scenario your inventory turnover ratio is going to be higher? What do you think? How is inventory turnover ratio calculated? COG is divided by average inventory. Now, in case of inflation, where would your inventory be less? inventory would be less than LIFO because COGS is higher. So now in LIFO, your COGS is going to be higher, your inventory is going to be lesser, which means it is going to turn into a higher inventory turnover ratio. Are you following this? Yes or no? Yes? Okay. So a LIFO would result in higher inventory turnover, a FIFO would result in lower inventory turnover. So basically, if you are clear with this concept, then no matter what ratio they ask, you simply apply the same logic and you can crack the questions. Are we clear with this 4 methods? So now the last part of this, there is something called a perpetual inventory valuation system and there is something called a periodical inventory valuation system. So let's take an example. Let's say quantity purchased. First dates, date 1, 2, 3, 4, 5. Quantity purchased 10 units, 20 units, 30, 50 units. Price 10, 20, 30, 40. What does this negative number means? It means quantity sold. Now, let's say that we are using LIFO. Now, let us assume that we are making these entries at the end of the month. And then if you are making entries at the end of the month, end of 6 months, end of 1 year, that system is called as periodical system. Then entries are made after certain interval, periodical system, periodical entries. Now, when you are making entries at the end of the month, you would say that there are 4 purchase entries and there is 1 sales entry. You want to calculate your COGS. You will say that though sales is made on 30, the fact that you are making this entry at the end of the month, you would not really worry the sequence of these transactions. You would say that I have sold 30 and Lastin First-Out, so 30 must have been sold from these 50 units. So your COGS is going to be 30 into 40, it's going to be
20 to 40.
You've sold 30 units?
Yeah.
So COGS. So 30 into 40, 1200. If you're using a perpetual system where the entry is made right after the transaction was done, that means on 4th, the moment goods are sold, immediately entry would be passed. And if that is the case, you would say that you cannot sell something that you are going to buy on 5th, on 4th. You have to pass the entry on 4th. So you would say that these 30 have been sold as 20 and 10. So 20 into 30, 600, 10 into 20, 200. Your COGS is going to be 800. That means depending on whether using your periodical system or perpetual system, your COGS is going to change in LIFO. Are we clear? Now let's assume a FIFO scenario. First in, first out. Again periodical and perpetual. Now in case of periodical system, let's say that I am making entry at the end of the month. Now first in, first out. So which one would go in out first? This 10 will go. This 10 will go and out of 20, 10 will go. So 10 plus 10 and 10 from here, so 30. 10 into 10, 100. 10 into 20, 200. 10 into 3, 300. 300 plus 200 plus 100, total 600. So COGS is going to be 600 if it was periodical. If I decided to pass entry on 4th itself, perpetual, there also is going to be same. So in perpetual, in FIFO, it does not matter whether you are using periodical or perpetual. The COGS and closing inventory is going to be exactly same. If I use weighted average, if I use LIFO, depending on whether it's periodical or perpetual, things are going to change. But if I use FIFO, no matter whether it's periodical or perpetual, my COGS is always going to be same. Are we clear? And why it is same? I'm making this sentence statement. You probably spend some time on this when you go back home. You cannot sell something that you don't have. That means when I assume the periodical system in LIFO, I assume that I sold 30 which were acquired from these 50 on 4th. But when I am using FIFO and I am selling on 4th, I cannot sell the 50 on which I am going to acquire on 5th on 4th. I can sell only of the goods those I already have, and therefore FIFO COGS is going to be same irrespective of whether it's a periodical or perpetual. So if you've understood this, we've done 100% of inventory. There is nothing that would come beyond this. So there are certain small finer points. So you just read through your books once and then you'll be comfortable with this. It shouldn't be difficult.